How's it going, everybody? Chad here. I just want to give a quick update on this current bull market. I made a video about 2 or 3 months ago, and you can check it out, talking about a potential stock market crash in 2015 or 2016. Um, the reason why I say that is just because most bull markets only last about 4 years on average. This one's been going on for about 6 years now, or over 6 years now, and it's the most artificial stock market run in the history of our country. We've never had an expansion like this with 0% interest rates and this unprecedented stimulus. So what's interesting right now is that the stock market is probably topping, and the Federal Reserve is considering raising interest rates. It may not be a meaningful interest rate hike. Obviously, it might be just, a quarter of a point or something, but 0.25% or half a percent or whatever dumb idea they choose. But the reality is the Fed has kind of boxed themselves into a corner, and it's sort of judgment day is coming in the next few months. Now, today they're supposed to announce if they're going to raise rates in September, and we'll see what they say. I think they're going to postpone one more time again. They're going to keep postponing until maybe December, but one of these days the Federal Reserve is going to lose all credibility. Now the question is do they raise interest rates into a bear market? That has never happened in the history of, our country. So we'll see what happens. Few things that are going on. Just to go back here, one thing I've been interested in gold since about 2007, and I actually ran into it from a guy named Peter Schiff, who predicted the economic collapse, and I was fortunate enough to read his book in 2006 or 7, and I just became so interested in the economy since, so I kind of got forced into learning about the stock market. And so I got into the stock market around, 2009. Now, I'm not going to say that I bought at the bottom and I've been riding this whole thing all the way up. That would be a lie. I did not. I've just been sort of learning about it and trading it here and there. I've learned that I'm not the very best short-term trader, but I'm pretty good at recognizing long-term cycles. And if we just look at the recent bull market here that started in 2009, there was a few fake outs. If you look at, just not to bore you, there was a head and shoulders here pattern, which is a very successful, trading pattern if you know about technical analysis. And usually it projects to the downside if you flip the head down. And everyone here was predicting, a retest of the 2009 low. A crash, and it never materialized. Now, the Fed did start stimulating at this right shoulder when it was below the 200-day moving average, so that may have been why it moved higher. But I've also learned that there's quite a few fake outs in the beginning of a bull market. Everyone's still scared, they're scared shitless in the 2009 bottom, but they're also scared and skeptical on the way up as well until it gets exhausted. And so you can see another head and shoulders right here forming, and it did actually successfully go through, and this was the flash crash of 2011, but it did end up bottoming. So many stocks were oversold in this bottom here that it ended up moving up, and here it just started grinding, almost a couple double tops and another potential head and shoulders. Now, what I've also learned, I've made a few rules here. If you see a head and shoulders and it's not below the 200-day moving average, which is this, if it does not break below the 200-day moving average, it most likely will not be successful. So this could have been a potential top in 2013, which would have been a 4-year bull market. But however, the top would have never been below the 200-day moving average, which it ended up failing, and it just kept grinding higher, and here we are today with a potential head and shoulders top. And I want to go and kind of zoom into this So I'm going to go to a shorter term chart. This is a chart of the same chart of the Dow Jones, which is a little bit closer, um, or this, about 2 years. And I'm going to, show what's going on here. So basically, if we draw a line here, there's potentially a new head and shoulders developing. The left shoulder, the head, and then the right shoulder is starting to form here. And the interesting part about this is, number one, it is below the shoulder would be completed, the head and shoulders would be completed below the 200-day moving average, and we're going into the fall, which is the worst part of the stock market. The stock market does not perform well in the fall, and most crashes do end up happening in September, October in particular. And so we can kind of, and the Federal Reserve is potentially raising rates in September, and very much so they will be confusing the hell out of the market if they keep, lying and changing their mind and stuff like that, because, it's just, they're running with their chickens with their heads cut off here. And so if this materializes here, the advanced decline line is also, falling. So that's another bearish setup. The unemployment or the economic statistics that have been coming out have been absolutely horrible. And keep in mind, we are in year 6 of this bull market, so it is really getting old and tired. And so we can potentially see this completing, which I've been wrong before. I will admit I've definitely been wrong before, but this could definitely materialize. So don't hold this against me if it doesn't. However, it's something to be aware of, and I would never buy stocks right now. It's just the market's too expensive in the United States, and we need to wait for a better opportunity, I think, to buy stocks. Or even this could be a potential short. If you want to make money on the downside, you could actually short these markets. I'm probably going to do that, and we'll see what happens. But let me just look at this. If we look at this head and shoulders here, basically it's a 2,000 point between the head and shoulders, and it would basically project down to about 16,200. But the interesting part about this is if we draw a line to 16,200, we got a bigger head and shoulders, forming, which could end up being early, late this year, early next year, who knows. It depends on how, fast this materializes, and also the way the Federal Reserve would respond if this market goes down 2,000 points very quickly. They may actually reverse their interest rate rises and do more stimulus, which I think is going to happen regardless eventually, but we'll see. This may cause them to rethink their policy, which will confuse the hell out of the market again. They may like the stimulus, but it may not work until it goes way lower and they start committing to buying just unprecedented amounts of garbage that's failing in the system, because the system is mathematically impossible to work. If you look at the debt ratios with higher interest rates, it's just impossible to work. And even with low interest rates, the economy now needs more QE to actually function, which I'm not going to say I don't believe it's going to work, but it does need more QE to actually function without a full-blown collapse. So I personally think they should stop QE and reset the system, but that's probably not going to happen. So if we look at this chart here with this bigger potential head and shoulders, here's the left shoulder, the head, and the potential for the right shoulder to build. This thing could blow down to another 4,000 points, which would bring us down to Dow 12,000. And so that's kind of what I'm looking for, a potential Dow 12,000 if the Federal Reserve does not hold the market up right here. And this is all hypothetical, obviously, so don't hold this to me, but I really want people to be aware of this. And now, just looking at gold here, gold has been in a bear market for 4 years, and it peaked out at 1900, but it started off the year in 2001 at below 300. It's gone all the way up to 1900, and now it's been forming sort of a base here um, at around 1100 to $1,000 per ounce. I don't think it will go much lower than 1100. It may go down to 1,000, but it's anyone's guess. But I think this is just a great opportunity to start buying here, or even if you bought in the $1,300–1,400 range, you're down, but you're not down if you bought at the 1900, which if you look at this move, it was just parabolic, and it just there's too much of the public was in this market, and everyone was favorable of gold right here when it blew off to 1900. I don't know if I'm pretty sure the market was manipulated downward, because when you're into this sort of setup with this predicament that we're in, things can go parabolic for fundamental reasons, and I think that's going to happen with gold. But they definitely postponed the day of reckoning, and this was where the flash crash was and everything in 2011, and now we're back down to $1,000 an ounce, $1,100 an ounce. So I think this is really, you don't buy things on the expensive, you buy them on the cheap. And right now the Dow is very expensive and gold is very cheap. And so I really think these two things are going to sort of flip, in my opinion. And we'll see what happens. I'll give another update as soon as I see something, but I really think the Dow is probably going to go a lot lower here, and the Federal Reserve is going to reverse their interest rate policy and pretty much shock the world. But anyone that's paying attention and can do third grade math will figure out that they can't raise rates anyways, even long term or meaningfully above the rate of inflation. So anyways, be careful, stay tuned, thanks for watching.